Fellow traders, 'tis I, the Rumpled One, coming to you on Wednesday, November the 5th. The year's 2025. Let's talk trading. Old school trading, part 2. These videos are for educational purposes only. Your results may differ from mine. As always, let's have our risk management in place so we don't lose more than we're willing to lose when we're trading. So, old school trading part 2. Um, if you didn't watch the video from yesterday, I was asking myself the question: how did traders learn 100 years ago? So I did kind of a deep uh, dive into the internet, and I came across a couple of books. And the second book that I'm going to talk about today, it's called Practical Hints for Investors. It's by Walker Van Riper, and it was in Barron's in 1926. So not quite 100 years ago, but 99 is close enough, right? And so I think it's kind of interesting when you look at the different topics, but the one I want to focus on, um, or the couple of them, there's like chapter 8, the best method of analysis. Chapter 9, how and what to study. Chapter 10, earmarks of the fraudulent promotion. And it's continued in chapter 11. And then they also have chapter 15, talks about speculation and investment. And then they also talk about, in chapter 17, the common faults of investors. And if anything, I think I might even want to start with the common faults of investors, because it says timidity, carelessness, speculation, successful investment possible for any man or woman. And so they're talking about timidity, meaning you're timid, you're afraid. And so that's going to knock out a lot of people. And then they also talk about carelessness. And it says a chief cause of the troubles which arise in operating a business is if you're careless. I mean, if you're careless with your trading, you know what can happen. And then, of course, um, the tendency to speculate. Um, they said there's no touchstone for successful speculation. The forces which cause fluctuations in the market prices of securities are too involved, too diverse, and too little understand to make such a thing possible. And that's just about it, if you think about it. And then the book ends by saying successful investment is something which any man or woman who proceeds along the right lines may easily achieve. It has never been so easy as it is today. Remember, this is 1926. Sound banks and safe investments are accessible to everyone. Only a few simple precautions and a few easy and definite investment standards and the understanding of 2 or 3 basic economic principles are necessary. I'm curious if you agree. If you agree with that sentiment. Um, so I want you to ponder that, and let's go through the charts. Maybe as you're pondering that, Keep a few of those things in mind. And we'll take a look at the monthly chart. We are what? 3 trading days into the month, and we're already 90 pips below the monthly open. You can see we're below the previous month's low. And that's 1, 2, 3, 4, 5, 6. We're below the previous 6 months low. What's that tell you? 127 off the high, 26 off the low, monthly low that is. For the week, which will be the same as the month, since the trading the open day for the month was Monday. So once again, and you can see here how many weeks we're below. And what do we have here? Oh, that's a missed pivot. I wonder. Target 12977. So that might be something to think about. Opening range for the week, you see we fell through yesterday, and Monday was an inside bar, so we had the same 2 reasons to go short there. Taking a look at the year, we're now only 524 pips above the yearly open. We're 755 off the high and 935 off the low. We're rapidly approaching the midpoint for the year. Once again, inside bar Monday, simple trade to the downside. And, keeping those old school ideas in mind, you can see that you really don't need a lot of fancy stuff. Because back then they didn't have it, and they said it was easy. Look at what we have now. It'd be interesting what a trader from 100 years ago would think about what we have at our fingertips today. And you know what? Be interesting. How well do you think one of those traders would do today? You think they would clean up, or do you think they'd get cleaned out? Let me know in the comments. Only 44 pips of range today. We can see the beast is taking over, the pound yen, 219 pips, with the new beast, the pound New Zealand, coming in right behind it, 191. Euro New Zealand, 195. What's going on with the New Zealand pairs? Aussie New Zealand, 100. Now the New Zealand USD, only 32. Now that's real interesting. Once again, taking a look here at the buy zone. You can see we're well below the weekly open. And there were some shorts across the daily open. But you notice we never closed below that short zone. But we did break above the buy zone. So it looks like there were some opportunities to take along. In fact, we were in the launch pad, 3 times today here at the 139 or 130.40 level right there. So you see we launched, well, not big launches, but there was definitely 5 or more pips to be had. And if you just look at simple chart reading, you see we put in a high close here. We didn't close above that high close. What's that tell you? Simple things like this. The range is too low for rat trades. Once again, 43.5 pips. That's just not enough range. But you could still find some reversal trades here, but just not going for the big pips. Bambino flex indicator said look for short. Pivot trading plan, look for short near the pivot. We got near the pivot and it's fallen down twice. We got near that yesterday low, but not quite hitting it. And we missed the pivot by 3 pips today. For the week, we're still below that pivot. And for the month, we're below that pivot. In and out of that lower wick zone a bunch of times. Once again, price doesn't like closing in the wick zone. Oh, looking here at the ATR and the dashboard. Nothing is screaming to take a trade here. As you can see, it's just waffling. And the ADP numbers came out today. I don't think we're going to have NFP numbers on Friday due to the government shutdown in the U.S. We barely broke the previous day's low and price just turned right around and shot up. You know, it's kind of interesting how, we look at 1 minute charts, 30-minute charts. Back in the old days, they didn't have that. They basically took the daily open, high, low, and close. Looking here at a trading chart, you can see here once again, price peaked this couple hours ago or an hour or so ago, is because the shaded bars are 30-minute bars. And you see here it dropped below the indicator 2 on M1, dropped below indicator 2 here on the M5, but it's kind of waffled between 40 and 45, that launch pad. So you probably pick up 3 to 5 pips if you're quick there. We got these closes. You can see here, indicator 2 drop down a bit, and then a nice short. The indicator 2 on M1 crossed below the indicator 2 on M5. And now once again, we're waffling back and forth. And frequency distribution, the range, you can see here greater than 40, 100% of the time over the last 100 days. But you can see we've actually struggled to get above 50, or didn't get above 50 9 times. That's a little early for that. If we drop this down to the M1, you can see a 3 ball. Once again, just, sometimes you just take the simple trades, simple entry, manage the trade, manage your money. Now, the difference is, what's the difference between managing trades, trade management, and managing money? The risk management part. Managing trades has to do with the aspect of the trade, meaning, position size, which correlates with risk management too, but, whether or not you want to put more on or less on, that's trade management. Risk management, on the other hand, is saying, hey, you know,